There's such a fine line, making money and losing money in the market.
We want to teach you the concepts.
You have to be okay with the type of trader that you are.
We're going to teach you the processes.
This is what really gives the meat and potatoes to it.
We're going to teach you how to.
The bottom line is you want to make money trading.
I can promise you that I can make you a better trader.
Join T3 Live at the Boca Raton Hotel and Resort April 26th and 27th for an exclusive trading education event. Sign up now.
Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the daily recap. So we walked in this morning prior to the jobs report. Futures were down. It wasn't the best looking tape prior to the jobs number, and then we got that jobs number released and futures just tanked. We had the S&P futures down more than 15 handles, a sharply lower open, triggered a little bit of panic and turmoil in the stock market that we haven't seen much this year. But in the spirit of this extremely resilient market, what did we get during the session? We traded back up, filled most of that gap from the morning, and at the end of the day, the S&P, after a very late rally to pair a lot of those gains, finished less than 0.5% lower. And so we continue to get that same MO for this market this year, that any weakness has been bought, and we've been able to rally back and reclaim any losses that we've had extremely quickly. But let's go a little bit more into that jobs report. Basically, we were expecting 190,000 non-farm payroll jobs to be created in March. The number came in at 88,000, which is extremely disappointing on the surface. But even more disappointing and concerning aspect of the jobs report is that you saw the unemployment rate slip down to 7.6% from 7.7%. And what that tells you is that people are continuing to exit the labor force. Discouraged workers who are unable to find jobs are stopping even looking for jobs. And a stat that I saw today, and I posted the link on Twitter to the article, but we had 63.3% participation right now in the labor force. 63% of people that are eligible to work and are considered within the age range and non-disability that are eligible to work, and 63% of those people are actually looking for work or have work, which is the lowest rate that we've seen since 1979. That's a truly alarming stat. Once I saw it, I knew that dynamic was alive in our labor market, but I didn't know it was that extreme. And that's a really concerning thing to see, and I think something that will continue to get more attention in the next couple of weeks as we talk about what this jobs report means. And I think one thing you're seeing, to continue to harp on some macro concepts, is that these spending cuts that have been triggered in the U.S. government, we've had the whole fight over the sequester and all that. I think you're starting to see some of the effects of those spending cuts. It'll be interesting to see whether that debate gets revisited and starts to get a little bit louder again as we get some of the disappointing data like we saw this morning. And you also have to factor in that today's jobs report came on the heels of a weak ISM manufacturing survey earlier in the week. So that's two very weak pieces of data points and two of the most important and most watched data points that you see. But that's enough talk about those macro forces. We're all about price action and technical analysis here at T3 Live, so let's go ahead and take a look at the chart of the spiders. And you can see we opened sharply lower this morning. Extremely bearish open, but what do we do during session? We trade all the way back up into the 21-day moving average. And to get a better look at the price action, we're going to take a look at, we got our Fibonacci time frames here. We'll take a look at it on a 55-minute chart. We'll zoom even down to a 5-minute. But off the open, you see 9:30 here. We pretty much rallied. It was a steady rally for most of the day. Not a ton of action. We'll talk more about what sectors led that bounce, but so we got a steady climb throughout most of the session, and then late in the day, like we talked about, let's go to the East Coast here instead of 24-hour. You got that late push into the close to take us back up, to fill most of that gap, and like I said, we only finished the day down about 0.45% on the S&P. So all in all, if you just simply came in and you looked at the loss for the day, you wouldn't think it was much of anything, but as I'm going to talk about later in this video, there's a lot of forces that say this market will continue to go lower despite the bounce that we got intraday. A couple of the signs, we talked earlier in the week on Tuesday, the S&P and the Dow closed at all-time closing highs, and I came in the recap and I said, even though we're closing at all-time closing highs, I still feel a lot more comfortable with shorts right here, and I feel like the risk-reward ratio is skewed in favor of shorts, despite all these headline closes that we're getting. And on Wednesday, we got a sell-off of more than 1% in the indices. And then yesterday, it looked like we just sort of waited for today's report. And then we got that downside pre-market after the week report. And all in all, this week, we only closed down mildly lower. But it'll be interesting to see what happens. But the reason on Tuesday why I came in and was feeling like I wanted to lean short a little bit was because of some faulty signals that we've been seeing in a few sectors, namely the Russell 2000, which is the IWM, and then in the Dow Transports, which is the IYT. And we're going to take a look at the chart here of the IWM. I'll show you what I was seeing. If we go back to the daily chart, is the market was holding up relatively well early in the week despite some of these pockets of weakness we were seeing, but you saw the IWM trade sharply lower. On Monday, it broke below its 8 and 21-day moving average. It opened higher on Tuesday, but then couldn't hold that and traded back down through those moving averages. And then on Wednesday, accelerated to the downside and didn't get much of an impressive bounce yesterday. And this morning, the IWM opened sharply lower, but was able to rally and lead the market back into positive territory. And I think this is one that was just so oversold that you got sort of a snapback reflex rally. But it's a somewhat impressive rally in the IWM, and it'll be interesting to see what it leads to next week. You look at the IYT, even more impressive today. You saw some weakness early after the gap down, and then you got a really impressive bounce back up above the 50-day moving average for the IYT. Another one that was just so extended to the downside and so oversold that it made sense that we saw a little bit of a snapback. You also look at the XHB, even more impressive perhaps. But you had that really sharp sell-off on Wednesday. It became very oversold, was weak very early in today's session, but then bounced really impressively. But it's still below its 50-day moving average, so macro composure looks like it's still not ideal for the XHB. And then you look at the XLF, the financials, also had an impressive day today. They weren't as beaten down as the other sectors, the IYT, IWM, and the XHB, but you saw an impressive bounce after a sharply lower open in the financials, and they're firmly back above their 50-day. We'll take a couple look at those financials. Goldman Sachs opened sharply lower, but was able to climb back above Wednesday and Thursday's lows, so was able to rescue some of its macro composure. The other short in the financials that we've been talking about a lot is Morgan Stanley. It basically filled that gap down to here on today's lower open. So for short-term traders, that trade could be off the table for now, but this is still one of the weakest financials and one that I would be looking to short on bounces. And that's a theme that I'm going to continue to talk about today, is shorting on bounces. Is that I'm going to go into that here after I do this little diatribe, but I think right now we're seeing a complexion change based on a few signals that we're seeing in the market, and I do think this market is headed lower despite the fact that we were able to rally back up and have some oversold sectors pair some of those losses from this week during today's session. But one of the big reasons and huge red flags today was the TLT, the 20-plus year Treasury bond ETF. Look at that huge move in the TLT today. People have talked about the theme of rotation out of bonds and into more of a risk asset in the equity markets. But today is evidence that people are still scared to pile their money into the stock market and prefer more low yield, less risky assets like Treasury bonds. The Treasury bond didn't tick down at all today while the market rallied. Traditionally, these are seen as somewhat inverse. There's a somewhat inverse relationship between the equity markets, the indices, and the bond ETF. But today, you didn't see that. You saw the market was able to rally, but the bonds did not tick lower. I think this is a huge sign that we are headed lower in this market. We might be able to rally a little bit next week after becoming, I guess you could say, slightly oversold on today's gap down. It was such a big move, but I think ultimately we are headed lower. I think another telltale sign is gold. Gold is another one that's becoming sort of a fear indicator for the market. Not completely contra. On Wednesday, for example, you saw all assets sell off. You saw gold sell off sharply with the equity markets. But today you saw gold gap up and finally show some commitment to a bounce. I talked in the morning call about wanting to buy this dip in gold at macro support. If you zoom out on the weekly chart, you see it's touched this floor multiple times and bounced. And I think macro support should be treated as macro support until it's proven otherwise. And this is a level that around that 150 mark, I think you could have tried some gold long, and then today's action sort of confirmed what could be a nice little bounce in gold based on the jobs report. And like I talked about this morning also, is that the Federal Reserve has a dual mandate to keep inflation under control and promote full employment. And the employment picture is a complete train wreck right now, as I talked about earlier. And so the Fed is going to continue with quantitative easing and build those inflationary expectations until the employment picture gets a lot better. And we're not even close to that. There was some talk earlier in the year about potentially cutting down QE and ending it or unraveling it sometime in 2013. I don't see any way that that's going to happen. And as long as QE continues and as long as those inflation expectations are high, it's a bull market for gold. And I don't think that bull market for gold is over. We'll go out to the monthly chart again, look at that chart. Look at this huge move gold's had for the last decade. You can zoom out even further. And when you look at it in that context, you're basically just seeing gold form a base up at this level. And until that upper floor is breached, I think this is a compelling place to buy a dip in gold and potentially get some protection for the ills that plague the market with central planning and quantitative easing and all those types of things. But enough talk about all that stuff. Let's go to a stock-specific look at things. And this morning, I talked about having a narrow focus, but looking at a handful of stocks that potentially you would like to go green after a gap down. And Facebook is one yesterday. They revealed the Facebook homepage that's going to be housed on the Android platform, and the stock was strong. It wasn't a sell the news on a Facebook event like we've seen sometimes in the past, and it was strong yesterday. It opened lower this morning, I think, completely due to market weakness. It just couldn't overcome that huge gap down, but for that reason, I liked it to go green today before any other stocks. It was my number one play this morning in the morning call, and we got really good action during the day in Facebook. It did close a little bit off its highs, getting rejected at the 50-day moving average, but overall, I think this news release yesterday is a really positive thing for Facebook, and I think you can get more upside in that stock. Another one that wasn't quite as impressive today, and it gapped down a lot bigger, was Nike, but this is more of a swing trade idea that I like. It wasn't able to go green, but it did hold that upper level flag or consolidation that we've seen since earnings. And I think anytime you see a stock digest and form a base after an earnings gap up, it's a sign that higher prices are in store. And this is one that I would definitely be looking at to the long side, Nike. Going to the other side of the equation, we're going to look at two stocks that are weak and one big name that was weak, and that's Apple. Apple went down and just about tested that pivot low at 419 today. It continues to be a major bear. It looked like it wanted to break out of its downtrend in mid-March, but once it broke back below that 50-day moving average, that was your sell signal, your red flag that Apple's going to potentially weaken, and it's not ready to really get that momentum and break out with any sort of strength higher. And then today we got almost a retest of that 419 level, and it'll be interesting to watch that 419 level next week to see if we get a break below it, and then potentially you could see Apple get down to the 380 area. We're not going to zoom out and look at it, but that's the next real support area for Apple is around 383. And that'll be something that traders, I'm sure, will be watching because they always watch Apple next week, for better or for worse. I think perhaps Apple's out of play and you should focus on other things, but something interesting to note because it is by far the biggest component in the NASDAQ index. And then Netflix is an interesting case to me, and one that is weakening significantly. You look at the candle today, and it tried to do what a lot of sectors did and a lot of stocks did, is erase gains from the pre-market and bounce after some recent selling pressure. But you see Netflix is below its 8 and 21-day moving averages, below its 50-day moving average, and really looks like it's running out of steam a lot here. It had basically a 100% move since that impressive earnings report, and is starting to lose its footing a little bit after squeezing shorts. And I think a lot of the move in Netflix you could attribute to a short squeeze, and when that happens, I think stocks at upper levels are on a little bit more fragile footing. But I'm going to show you the action intraday that really has me thinking that Netflix could go lower. Is that off the open after that gap down, we had a really impressive bounce, but it got rejected on the 5-minute up at its 200 period moving average there, and then traded, almost lost all of the gains from the session and finished the day in negative territory. I think this is just another example of high beta tech being a huge problem area right now. As you had the XHB and the IYT and the IWM show a little bit of strength today, and they were actually able to snap back from those recent losses, but you have tech, which is an even broader sector in the market, continuing to show weakness, and that's going to be a huge problem going forward, and one of the many reasons why I believe firmly that we are headed lower. None of this flexibility, if we break this, if we break that, we're going lower. I'm telling you right now, I think we're going lower based on the action in the bond market, based on the action in gold, and then those other faulty signals that we've seen in various sectors. So that's about as straight as I can give it to you right there. Next week's action will be very interesting, and we'll be watching all these same clues for potential market direction. Have a good weekend.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.